Welcome to Financial Insights in Minutes. Today, we're summarizing the latest buzz from the day's top financial videos. We'll delve into critical topics like the implications of Bitcoin's future amidst a shaky economy, alarming declines in savings across America,
and what's brewing in the turbulent housing market.
Don't miss insights from experts warning about a possible tech stock bubble too.
Together, we'll break it all down to save you valuable time.
So let's jump right in and see what our experts have to say. First, W. Scott Stornetta discusses Bitcoin's potential rise against the dollar and its political implications. Next, Jeff Snyder warns about a drastic decline in savings, signaling economic distress. Then, experts unveil the risky state of Austin's housing market as prices begin to plummet. Tommy Thornton shares his insights into the tech bubble and its potential hazards for investors. Lastly, Bob Elliott explains how shipping costs can disrupt the economy and affect consumer pricing. Welcome to the channel. Today's discussion raises the question, is Bitcoin poised to replace the dollar? We're thrilled to have W. Scott Stornetta, a pioneer in blockchain technology, joining in. Scott's groundbreaking research in the early 90s laid the foundation for Bitcoin.
Indeed. With his impressive background and experience, Scott is a key voice in both crypto and AI developments. Let's dive into this thought-provoking conversation.
So what's the main thesis of this intriguing discussion?
Scott argues that upcoming political shifts, especially with a potential Republican win, could lead to more favorable regulations for cryptocurrencies, shifting business dynamics in the U.S. substantially.
Let's break down some key points. What does Scott say about political influence on crypto?
The Republican Party is setting the stage for pro-Bitcoin policies, while the Democrats are also slightly moderating their views. It's a fascinating shift.
Interesting. What's the scoop on the SEC and new regulations?
Scott mentions that the recent Chevron ruling could limit the SEC's regulatory power over crypto, suggesting a more business-friendly environment.
And what about Bitcoin's integration into society?
With more than 20% of Americans now owning some form of cryptocurrency, the acceptance of Bitcoin is rapidly increasing, especially with recent ETF approvals.
What about the central bank digital currencies, or CBDCs?
Scott raises valid concerns about privacy with CBDCs and discusses the debates around whether they should be banned or not. It's quite a hot topic.
Let's hear Scott's predictions on the crypto market.
He expects a more favorable environment for cryptocurrencies in the U.S., with increased adoption and regulatory clarity, especially if a Republican candidate wins.
To wrap it all up, what should we take away from this?
Scott emphasizes the pivotal role of political changes on cryptocurrency adoption and calls for proactive engagement in these discussions. Are you ready for a Bitcoin future?
Welcome to Eurodollar University. Today, we're diving into a shocking trend. Americans are running low on savings. Joining us for this discussion is Jeff Snyder, Director of Research at Eurodollar University.
That's right. Jeff's deep understanding of macroeconomic conditions reveals why this savings trend is concerning for consumers and the economy overall.
So what's the crux of Jeff Snyder's argument here? Why is this decline in savings important?
The core thesis states that the savings rate has tumbled to just 3.4%, marking the lowest we've seen since late 2022. This decline signals that Americans are struggling to keep up with the rising cost of living.
Let's break down those key points. First, what's happening with the savings rate?
The latest data shows that the savings rate has plunged to 3.4%, the lowest it's been since late 2022. It's alarming.
And what about income? How is that playing a role in this savings crisis?
Nominal income growth is slowing significantly, yet consumer expenses on goods continue to rise, forcing many to exhaust their savings. It's a tight squeeze.
What's going on with consumer confidence?
Consumer confidence is taking a nosedive as savings deplete. Plus, rising unemployment creates anxiety about future job security, pushing people to tighten their wallets.
And the reliance on credit cards is troubling, right?
Absolutely. Consumers are increasingly turning to credit cards, and reports show rising delinquency rates, which is a red flag for the economy.
So, what are the predictions stemming from these trends?
The implications are clear. With the savings rate dropping, it signals a looming recession. As consumers cut spending even more, we'll likely see significant negative effects on the economy.
Anything else we should be aware of looking forward?
Yes, the anticipated widespread cutbacks in consumer spending might lead to a spending crisis. As confidence continues to dwindle, it could trigger market reactions.
Wrapping it up, what do we need to take away from this discussion?
The key takeaway is that the downward trend in savings is a critical sign of economic distress. It indicates that without substantial changes, Americans face tougher times ahead.
Any final thoughts on how this may affect the economy?
Indeed, the ripple effect from saving declines into consumer spending can deeply impact broader economic conditions. It's a mosaic of challenges ahead.
Welcome to MHFin's YouTube channel. Today's critical topic is the looming housing crash in Austin, Texas, the city that has been in the spotlight for its skyrocketing home prices.
That's right. Austin's housing market skyrocketed over the past 5 years, but recent trends indicate a serious downturn. Let's dive into what's going on.
So, what's the main argument here? What's causing this chaos in Austin's housing market?
The core thesis is that Austin has seen a staggering 101% rise in home prices, followed by a sharp decline. This rapid price increase has made it vulnerable to a crash, fueled by a mix of overbuilding and a decline in tech job postings.
First, let's talk about the price surge. What's the scoop on the numbers?
The typical home payment jumped from $2,500 to nearly $4,900 monthly. That's a whopping increase of 140%. But now we're seeing significant declines already underway.
How did the tech boom play into this pricing frenzy?
Tech giants flooded Austin, bringing high-paying jobs, but now, with tech positions dropping over 70%, the housing market feels the pinch.
And what about overbuilding? That's a big issue, right?
Absolutely. Home builders went crazy, pulling way more permits than necessary, and that excess inventory could flood the market just when housing prices are falling.
Those good old supply and demand laws are at play. What's the current state of inventory in Austin?
Currently, Austin surpassed 10,000 active listings, a rise of 74% since February 21. This is crucial when assessing future pricing.
Looking ahead, what predictions are being thrown around regarding housing prices?
Experts predict significant declines as sellers start to realize their homes might be worth 20 to 30% less than expected due to skewed market perceptions.
And what about the influence of the tech sector on these predictions?
If Austin's tech jobs take another hit, the housing market may struggle even more. This could lead to a correction reminiscent of the late 80s.
To wrap it up, what are the key takeaways from this analysis?
Austin is set on a precarious path, and buyers should proceed with caution. The factors of overbuilding and reliance on tech jobs are creating a storm. Whether it leads to a crash or just a correction remains to be seen, but it's clear that Austin's market is changing.
Welcome to Blockworks Macro on YouTube. Today, we're diving into the intriguing world of tech stocks with insights from veteran trader Tommy Thornton. With years of experience under his belt, Tommy has a unique perspective on the current market trends and potential bubbles.
That's right. Tommy shares his observations on active management and how tech's excessive valuations might lead to a bubble. Hold on tight as we unpack this complex topic.
So, what's the crux of Tommy's argument?
The core thesis is grounded in the belief that the current tech stock market resembles a bubble due to its heavy reliance on a handful of stocks like Nvidia, Apple, and Google. Thornton warns that these valuations seem excessive and unsustainable.
Let's break down those key points. First up, what does Tommy say about market dispersion?
Tommy points out that currently only 24% of S&P stocks have outperformed the index, signaling a troubling lack of dispersion. And when it comes to tech, only 42% are beating the average. Sounds like a crowded trade.
And what about the recession talk?
Thornton sees a recession looming within a year. He emphasizes that if the Fed cuts rates, it could lead to even more significant economic risks. A big warning sign.
And how are tech valuations holding up?
Tommy highlights Nvidia, noting its market cap inflation after tremendous growth as a key indicator of excess. He flags that price-to-earnings ratios are wildly high, particularly for their industry.
Interesting. What's happening with market sentiment?
Thornton notes that sentiment indicators show extreme bullishness, with 64% of investors feeling optimistic. Typically, that's a danger zone, something to watch.
And what predictions does Tommy have for the market?
He expects a market correction in the next year. A downturn could be triggered if the heavily invested mega-cap stocks start to lose momentum. Get ready for some turbulence.
Let's wrap it up. What are the key takeaways from Tommy's insights?
Tommy's perspective urges investors to stay cautious about the tech market, especially given its bubbling valuations and the looming threat of recession. It's better to be safe than sorry.
Anything else for our viewers to keep in mind?
Absolutely. Monitoring market sentiment is crucial because overexuberance can lead to significant losses. Keep your eyes peeled, folks.
Welcome to today's enlightening episode on the economics of shipping. We're diving deep into how the shipping industry influences global markets.
That's right. Bob Elliott's insights will help us unravel just how shipping costs affect our wallets and the economy.
What's the central thesis here? Why should we care about shipping costs?
The key idea is that while shipping costs may not seem high, disruptions in shipping have a far greater impact on pricing and the availability of goods.
Let's break down those key points. How impactful are shipping costs, really?
Well, shipping costs typically only account for about 0.5% to 1% of the total price of goods. The disruptions and the resulting delays are what truly affect consumers.
Interesting. What happens when shipping gets disrupted?
Delays lead to inventory shortages. When consumers need products but can't find them, prices start to rise. It's a classic case of supply and demand.
Let's talk about the capacity of shipping vessels.
Exactly. Building a new container ship can take 1 to 2 years. When shipping capacity is constrained, prices can skyrocket due to high demand versus limited supply.
How do these shipping economics affect global trade?
Timely shipping is critical for global trade. Disruptions can ripple through various industries, affecting prices everywhere.
Now, any predictions on what's next for shipping?
Expect continued volatility in shipping prices. This can lead to rising costs of goods for consumers, so keep your wallets ready.
What about long-term changes?
With economic growth comes higher demand for shipping. Plus, any new regulations could throw a wrench into shipping costs.
Wrapping it all up, what's the final takeaway?
Becoming aware of how shipping costs influence market trends is crucial. Disruptions are inevitable, but anticipate greater impacts on pricing than you might think.
In today's discussion, Stornetta stresses that improved political support could usher in a new wave of crypto adoption, specifically for Bitcoin.
Meanwhile, Snyder brings attention to the troubling savings rate decline, warning that this could disrupt consumer confidence and economic growth.
Austin housing experts are cautioning viewers as home values continue to decline rapidly, with many believing we're on the edge of a serious crash.
Lastly, Thornton warns of the inflated tech stock prices, suggesting that excessive valuations might lead to a market correction in the near future.
Thanks for watching Financial Insights in Minutes for July 29th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.